Ladies and gentlemen, welcome to the session where we are going to discuss the rise and fall of working capital needs. My name is Buysse. I work in the M&A world. I'm a managing partner for Clairfield International. Who is Clairfield International? We are a M&A international network and partnership, and we focus on mid-market transactions. Next to that, I preside the Belgian Association of Financial Analysts, and I'm the chair of EFRAG, the European Financial Reporting Advisory Group. Okay, so welcome. We are going to have a look at, first of all, how the M&A markets evolve. We're going to have a look at the process of mergers and acquisitions. And then last but not least, we're going to have a deep dive into those working capital needs. Let's start with the M&A landscape in Belgium. We are 2022, so we are looking at the figures of 2021. We see that values are still going up. We expect 2022 to slow down a little bit into that effect, point one. We also expect that the use of debt is going to decrease and the use of equity is going to increase. You can see that on the slide right-hand side, where you see evolution of enterprise value over EBITDA. So we are still on all segments around 7 times EBITDA in valuation, which is still pretty high. We do expect, as I said, that this will go down a little bit in 2022. And we see that more or less we need 33% of equity. There as well, we get a lot of, let's say, negotiations, discussions with banks, financial institutions that do discuss the level of leverage on M&A deals. But so far, 2/3 of debt, 1/3 of equity. What is interesting, however, is that a number of people do not close the transaction immediately. They want to have a vendor loan or an earn-out, meaning that they're going to sell, first of all, 70%, for instance, of their share capital and keep 30% over a period of, let's say, 3 years. The only, let's say, reason why they do that is because they want to be sure that the target that they have just acquired is performing well, is performing better, and since they expect it's going to perform better, they are willing to pay a little bit more, but not cash at closing. A little bit later is the main message. Okay, let's have a look at this process. A process in M&A is consisting out of a number of steps. What I'm showing you on the slide right here is in reality the big blocks. So you first need to pitch if you want to get the sale mandate. You are, for instance, an advisor, an M&A advisor, an investment bank, and you would like to get this sale mandate. Well, you have to pitch. We'll get back to that in a sec. Then probably when you have the mandate, you will need to test the market. I mean, is the market interested in the company that you have to sell? And you will need to get from a number of candidates a list, 10, 15 non-binding offers at a certain stage. You are going to pick the best ones, drop the least interesting, let's say, non-binding offers, and then go with these candidates into a due diligence. Literally, we go from 15 to 7, 8, sometimes 5. And then once those people have done their due diligence, they need to make a binding offer. If they make a binding offer, it means it is binding. They just have decided that they will buy this company, but according or subject to a very limited number of conditions. We'll get back to that. And then the interesting part also for today is we will negotiate. What are we going to negotiate? We're going to negotiate all the legal documentation of the transaction. The most important one being the SPA or the share purchase agreement. And then last but not least, we will close the transaction. Now be careful. You see here nice these number of small arrows, but it means that already when you receive the non-binding offer, so step 3, you're going to start discussing the integration of the company that you want to buy. And I, as a, let's say, advisor to the seller, I'm going to help the buyer also negotiate the integration of the company that he is going to buy. First question, how many steps are there? Well, I showed you only 7, but in reality, there is a lot more. The question is, how many more are they? Some people think, well, it's less than 10. Well, I already told you it's going to be more than 10. Some people think it's between 10 and 20. And some people say, no, 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 it's definitely more than 20 steps. Ladies and gentlemen, you're probably not going to believe this, but on average, it's 32 steps. However, here and there, we can take some shortcuts, but not everywhere, but we can take some shortcuts. So first of all, you need to pitch. You need to pitch to get the sale mandate. So already here, there's a number of steps that you will need to take, and be careful. I'm telling you, this is a pitch, so you're not being paid for this. You do this for free. It's you trying to get in with a company that wants to sell a company or the company, and you're going to try to get the sale mandate. First thing you will need to do is you will need to prove to the seller that you actually know this market, that you know the sector, that you understand the mechanics of the sector. A small example, if you need to sell quick, most people think with restaurants, for instance, or McDonald's, most people think, oh, this is fast food. Well, in reality, if you really understand the sector, you'll discover that this is real estate. And most of the focus is on that real estate. Second thing you will need to prove is, how good are you? And if I say a track record in M&A, it's not only you or the company you work for, it is definitely only you. This is about, is this person capable of selling the company that I want to sell? And is he the right person? Third element is, of course, the inevitable question, so nice, you're going to sell my company, but who are you going to sell my company to? So who's the detailed buyer's universe? And this is a lot more than an NACA code of a number of companies. This is knowing the competition, knowing who leads the competition, and being able to access those people as well. And then comes the interesting part, the valuation of the company. We'll get back to that in a sec, but last but not least, you'll need to tell your future client how much you're going to charge in order to sell this company. Okay, how are we going to value the company? Now, this is an easy one. I did not hide it away. I mean, it's going to be DCF, discounted cash flow, plus multiples, plus net assets. So you better prepare. Do not forget, we're still in the pitch phase, so you will have to do this for free. If we do that DCF, one of the interesting parts, and that's the most interesting part of today, is the net working capital, or what we also call the working capital needs. Now, bear a second with high attention to this one. If we say net working capital, this is simply the current assets minus the current liabilities. But in reality, this is about the matching principle. It's about equity. How do you fund this company on the long term? Through equity. How do you fund this company on the long term? Through debt. And once you have financed the fixed assets, what is left to that? What money, what cash do you still have left in order to run the business? So this is about what we call the cash conversion cycle. We call this also the working capital needs. How much money do you need to run the business? So the top part of the slide is, what is your structural position? What do you have? The bottom part of the slide, the working capital need, is what do you need in order to be able to run the company? And then of course the third bullet point completely at the bottom is a logical one. If you take the net working capital, what you have, minus the working capital needs, what you need, you get the net treasury. Read, if you have more money than you need, you get cash. If you have insufficient money than what you need, you will get financial net debt. Just a small example to you, ladies and gentlemen. If you now look to two kind of companies, and I've taken them deliberately. I could have taken as well Delhaize Food instead of Albert Heijn Foods, and I could have taken, of course, the most Belgian known brewery instead of Heineken, but Heijn and Heineken seem to be a nice one. Now, if you look at Heijn, fresh foods, how quickly do people think that the clients need to pay if they buy something from Heijn Food? Now, that's in reality an easy one. You don't get out of the shop unless you have paid. So the days of sales outstanding of the receivables rotation in days is 0. Then the stock rotation, or the days of stock outstanding, well, that is only 1 day. And just check yourself. If you go to Albert Heijn, you want to buy bananas, you want them exactly green, but not too green, because then they're not good enough. And you certainly don't want any brown spots on the bananas, because then you're not going to take them, be honest. You're going to take those that are exactly good. So stock rotation, in all honesty, a day, sometimes 2 days, but not a lot more. But then the big question comes, when is Hein going to buy or pay its suppliers? So what is the purchases outstanding in days, or the so-called DPO? You're not going to believe this, but it's 120 days. So literally these companies in food are going to sell the products, be paid immediately. They're going to have a stock rotation of 1 day, and they need to pay their suppliers 90 to 120 days. So my very, very easy question to you is, if the turnover rises with 100 million, so increase of turnover 100 million, what is the cash effect? I'll let you think for 2 seconds and then I'll give you the answer. Since the rotation is in receivables 0, and it's close to 0 as well in stock, so it means that you simply get the money in, you sit 120 days, a third of a year, and then you're going to pay for it. So in other words, your cash period, the time that you can run this cash, is a third of a year. That is why we say if you sell 100 million more, well, 1/3 of that is going to be cash for you, increase in cash, because the working capital needs are negative. 100 million increase in turnover gives you 33 million, 1/3 extra cash. Now let's look at the other one, Heineken. Heineken has a days of sales receivables rotation of, let's say, 120 days. I'll get back to that. Let's start with the easy one. The stock rotation in days at Heineken, stock and work in process, is 45 days. They need to pay their, let's say, suppliers also 30 days end of month, let's say, bottom line, 45 days. So it means if the work in process takes 45 days and they get 45 days to pay their suppliers, those two compensate each other. Where on earth do I get the 120 days? Well, I'm going to tell you a little secret. You know that Heineken is one of the main suppliers to Albert Heijn food. So if Albert Heijn can wait 120 days in order to pay Heineken, it means that Heineken needs to wait 120 days before Heineken gets the money. So they are the reverse, the image of the other one, the mirror of the other one. Or in other words, if Heineken now has a turnover that rises with 100 million, well, guess what? What is the cash effect going to be, since they have 45 and 45 days compensating? That is 0. And then they need to wait 120 days, a third of a year, before the clients are going to pay them. In this case, Albert Heijn going to pay Heineken. Well, logically speaking, for every 100 million that the turnover rises, they need to fund an extra cash outlay of a third of a year. Read 100 million times a third, 33 million cash shortage or working capital needs. Bear this in mind, because this is one of the most important parts in valuing companies, because the movement in those working capital needs, so the fact that you need more cash, is going to drive valuation of the company. If you have a shortage in cash and you work with a DCF model based on free cash flow, the movement where you need more cash, like Heineken, is going to be deducted from the value. And if you are Albert Heijn and you grow, so it means for every 100 million you get 33 million extra cash, well, on a free cash flow basis, it means the cash flow valuation moves up with 33 million. Bear it in mind. So let's go quickly through the rest of the steps of the M&A transaction. So you did the pitch well, you got the mandate, you're going to contact a number of potential buyers. I remember you had the list, but you did not talk to them. You're going to check who is good, who is not good, so your long list becomes a short list. You send them, logically speaking, a NDA, as we say, and an NDA is a non-disclosure agreement, and a teaser. You give them information, an information memorandum, you explain them how the process works, and then you expect to receive a non-binding offer. So far so good, no issues. You ask them, of course, if they are capable of funding the transaction, which is pretty important nowadays. Then if you have those candidate buyers, you're going to rank them. You're going to do an assessment of those candidates. Are they good or are they not good? But since control is better than simply be smiling and be friendly, you're going to check their account. So we are going to have a due diligence process on their financials, on their strategic points, their commercial points, their IP points, whatever. And then you're going to ask them to provide you with a binding offer. Now here it gets serious. It means the offer is binding. They cannot get out like that. There might be some issues, smaller reasons why they can get out, for instance, concentration of market power, but normally it means you're ready to sell the company. The only thing you need to do is file for the antitrust authorities. We live in Belgium and the Benelux, so we need to inform the Workers' Council. We agree on the heads of terms, so we are agreeing on the, let's say, sale of the company. We assess the best buyer, and the best buyer gets exclusivity. So we're almost there, and then you're going to face the problem I would like to explain to you today. So now we're going to start negotiations. What do you mean negotiations? Only in step 23. Yeah, you're absolutely right, because here we're going to negotiate all the legal documentation. So it means now the lawyers come in, the accountants come in, the fiscal advisor comes in, or the tax advisors come in. Everybody is sitting in the same room, and we're going to negotiate the final contract up to the moment where we sign the SPA. Wow, so it means we're almost there. Well, not completely, because that depends now a little bit on how the process works. Why am I telling you this? Well, we still have the negotiations, I just told you. We're going to negotiate the share purchase agreement, but sometimes it is an asset purchase agreement. If I do not sell everything, I work with an earnout, remember, then I will need to negotiate the shareholders agreement. We need to sign the management contracts for the people that remain in the business, and then it goes pretty quickly. We sign the whole thing. We close the transaction, most important part, because here stops the responsibility of the seller and the responsibility of the buyer starts. We're going to settle the whole thing, pay the price, but now be careful. Are we paying 100% of the shares that we're selling? Not really. The buyer mostly pays something like 85% because he wants a security, a guarantee in case something goes wrong, and he puts that guarantee on what we call an escrow account. And then we still need to think about, and here we go again, think about the working capital needs and think about the net debt. That's what we do in the closing accounts. And that is also where we have now and then issues when we close a transaction. Let's show you what I mean with that. Well, it's coming from a real transaction, and we were first of all negotiating with the buyer. No, I was working for the buyer, I apologize. We were negotiating with the seller that we were going to work with a lockbox. It means no adaptations of the working capital needs. In the due diligence which I showed you, we fix the working capital needs level and we keep it. We close a deal, done. This is something that you see more and more. So if you read the text here, it says a mechanism where parties agree on a fixed equity price at the outset of the deal closing, usually based on a recent balance sheet and income statement of the target company. But in this case, my client agreed at a certain moment to say, look, we are willing to do a net financial debt adjustment on the one hand side and a non-traditional working capital adjustment on the other hand side. I still wish they would have never given in on that one, but they did. What do I mean with a non-classical, let's say, adjustment on the working capital? Well, we decided to do it on days of sales outstanding, days of purchase outstanding, and days of stock outstanding. So the relative amounts and not the absolute amounts. So we were working the cash conversion cycle. And now, bear with me still the story of Hein and Heineken. So we made a number of calculations. We agreed to say, look, if the cash conversion cycle becomes longer, at that time, evidently, for us, the value goes down because you have to wait longer before you get the money. If the cash conversion cycle goes shorter than originally planned, then of course it means that the company gets the money quicker, and that is value enhancing. We made the calculations very specifically. We took working capital needs on a monthly basis 12 months prior to closing, and then we compared those 12 months with the 12 months before that. So month minus 12 to month minus 24. And what did we notice? We noticed indeed that suddenly the stock went up. If you look to the top of the slide, you can see that at a certain moment in time, we saw differences and the stock rotation went up with 28 days. So our logical conclusion was, okay, so we need to correct the price in favor of, let's say, the buyer. He needs to pay less because the stock moves up. And then we were very, very surprised when a counterparty, which was a large investment bank or supported by a large investment bank, told us, you guys are completely wrong, this is not correct because you have more stock. And since there is more stock at closing than you thought there was stock before closing, you should pay more because you get more stock. We said, no, this is completely the adverse. The proof is there, the number of days, not the absolute amount, because the absolute amount in stock can go up. If your turnover goes up, your cost of goods sold go up, and it's not illogical that the stock would go up. But this is the stock rotation that goes up. So the stock rotation goes up, it means you sell slower, you have idle stock, and that difference, which you see on the slide, should come off the price. We discussed for weeks on this item, and finally they gave in, but we needed to go even the academic route, looking for really evidence in the academic literature saying, no, if you work the cash conversion cycle and the stock goes up, then the value goes down. Lesson learned for us is, if you make an SPA, please describe this mechanism very, very well in the share purchase agreement to avoid surprises later on. Thank you very much for your attention.